All right, everybody. Ignatius Jackson CPA here, doing a live for the probably only second time or third time maybe that I've done this. And so we're going to go ahead and talk about Trump tariffs and the impact these might have on the economy, impact they currently have on the economy, and some other things. And then we're going to go through some stocks and just kind of hopefully settle everybody down just a little bit. But we're going to talk through some things to, get you guys some perspective, or at least my perspective anyways. And so just want to talk through first about some of the tariffs and some of the stuff that you're kind of hearing out there. Obviously, there's two sides to the equation. Some people will say that these tariffs are going to be super inflationary. It's a tax paid by consumers. It's going to cause a recession, cause job losses, et cetera, et cetera. Okay. Obviously, those things can all possibly happen. Maybe they will happen. Some might say it's very probable that it will happen. But I really don't think anybody really knows for sure. And you got the other side of the equation, which is where tariffs are going to be used to force companies to come back to bringing manufacturing back to the U.S., plants, add jobs, those sorts of things. You're going to have a small drop in the stock market, sure, or maybe a big drop in the stock market. And it's just really an excellent buying opportunity. And we're going to go through some stuff here to show you how that likely is the case. And then you're going to have some interest rates that are going to be pushed downward. We're already starting to see how the treasury rates are starting to come down, and likely the Fed will go ahead and follow suit here in the near term. And then you got long-term job growth that's going to increase from all the manufacturing jobs as well as other jobs that probably will hit the market. So just kind of my perspective on what's been happening over the last couple of years. The government has essentially propped up our economy. Our economy has grown quite substantially over the last couple of years due to incessant spending by the government and incessant job growth by the government. So these things have led essentially to inflation, in my opinion. And that is what is ultimately causing a lot of the current downturns, is because the market was so high, the economy was just propped up so much that the market is basically going through a little bit of a correction currently, which is perfectly fine, perfectly normal. It happens at least every couple of years, sometimes more frequently than that, sometimes less than that. But it's something that the market constantly does, where it'd go down 5-10%. In this case, it looks like it's going down maybe 20%, potentially maybe even 30%. You're seeing some stocks be down quite substantially from their recent highs. But it's something that is not really anything to be scared of. It's not anything that you should be concerned about in the long term. Obviously, if you have a shorter term on your investment cycle, like you're about to hit retirement age, things of that nature, I know it might be freaking out a little bit. But just give it some time. It'll bounce back up. And at that point, you can go ahead and rebalance that portfolio and get it into something a little more conservative that you might want to alleviate some of your risk, okay? And so what I'm going to do now is go ahead and share my screen. And we're going to go through a list of the Magnificent 7 stocks and what they've done over the last, we're going to go through a progression of the last 5 years. You're going to see a lot of these stocks are not even down over the last year. If you look at the last year in terms of their growth, they're not even in a negative return for the last year. So again, why are we freaking out about this? I don't know, but it's something that you want to kind of think about and consider as you're looking at what you're going to do with your portfolio. Long story short, right? The people who are making the most money off of what's going on here are the people who are buying this, into the dip, right? What time, when exactly you want to buy into the dip, that's, your prerogative. But, those are the people who are going to be making the most money off of this thing. And before we go any further, disclaimer, legal disclaimer, right? So everything that we're talking about in this video and anything on my YouTube, X channel, Instagram, all my social media, it's always for educational purposes, right? Obviously, I'm a CPA and a personal financial specialist, which means I do financial advisory services for people. I also do tax advice and things of that nature. But because you're not an actual client, you haven't engaged us for a particular type of service, this is not considered tax advice, this is not considered financial advice, and it's not considered legal advice. And so If you need assistance with any of those things and you want to cover yourself for any of those things, then you're going to want to engage someone professionally to help you out with that. So get that disclaimer out of the way so that everybody kind of knows that about this video. Okay. So we're going to go into looking at some stocks. Again, these are just some stocks that I kind of picked that I think are owned by a lot of people, and something that I think will be beneficial to you to see kind of some of the trends and just kind of maybe quell some of your concerns a little bit. Okay. If you're on Instagram, unfortunately, I couldn't figure out how to share my screen on Instagram. So go over to X or YouTube, whatever your poison, and you can see the screen share. Okay. So we got some stocks here on the list. Okay. So Tesla, Nvidia, Apple, Meta, Amazon, Microsoft, and Alphabet. All right. Then we have 4 ETFs, Vanguard ETFs. I like Vanguard ETFs personally just because they're usually super low cost ETFs, and they have a pretty good track record. And so we're looking at VOOG, which is the S&P 500 Growth ETF, the Vanguard Growth Index, the Vanguard Total Stock Market Index, and the S&P 500 ETF. Okay. So as you can see, for today's market, right? Tesla was the biggest one that was down 10% for today. These other ones down in probably an average of like 5% for the day. Okay. And then you got Bitcoin. I forgot to mention Bitcoin at the very bottom here. That was the only item here that was, it's not technically a stock, but it's an investment that a lot of people are making now. That's the only one that's up by about 1% if you round up a little bit there. So 0.75% there. Okay. And so we're going to look at the history of each of these individually and just so you kind of see some of the history here. All right. So Tesla. All right. So obviously today is down, as we just said. But if we look at the last 5 days, what happened? Okay, it's down 4% for the last 5 days. Look at the last month, down 12%. 6 months, down 4%. Year to date, oh, whoa, down 41%. Okay. It is down a lot year to date. It's down 41%. That's crazy. But let's look at the last year. Oh, look at that. It's up 40% over the last year still. So even though it's down 40% year to date, which is for basically the last 3 months, right? Quarter just ended. Okay. It is over the last year up 40% still. So it's still in a positive net gain over the last year if you've been invested in it for the last year. So you're worrying about something that likely is not a long-term issue. Okay. If you look at the last 5 years, up 648% over the last 5 years. That's over 100% per year gains in this stock. Okay. I mean, that's pretty good. So should we really be concerned that Tesla is down 40% right now? Probably not, especially given that, right? It's not even just the tariff forces that I think are causing this. It's a lot of political and just bad news and the stuff that's going on with Elon and the Doge whole thing, the Department of Government Efficiency. That is what is ultimately, I think, driving Tesla down so much. It's a combination of the tariffs, obviously, which they are impacted a little bit with that. But, they're the most American-made car that's out there. Okay. It's still not 100% American made, right? And that's because the parts that go into it come from foreign countries still. So Tesla still has a lot of parts that are coming from foreign countries, but it is definitely the most American made car in terms of the percentage of components and everything that are being manufactured here in the US. And so it's in a stock that really you should, if you're pro-America, then hey, it's a good stock to have because if you believe in the tariffs, then likely it's going to benefit you long term. If you don't believe in the tariffs, chances are the company's still going to do great. It's one of the best electric vehicle companies out there. I personally am not a huge electric vehicle fan, but I know there's a lot of people that are. And maybe once the technology gets a little bit better, I'll become an electric vehicle fan. But right now, it's just a good stock, I think, to own. So just some perspective there on Tesla. Let's look at Nvidia. All right, Nvidia does a lot of AI chips and stuff like that, right? So they're supposed to be this darling. All right, down 7% today. Last 5 days, down 10%. Last month, down 19%. Last 6 months, down 24%. Year to date, down 30%. And the last year, it's still up 10%. So NVIDIA is still up 10% in the last year, even though it's down 30% year to date. Okay, down 19% in the last month. It's still up 30 or 10% of the last year. And look at the last 5 years. What? 1,446%. That's a lot per year, right? That's over, well, let's see, 280% roughly per year in gains. That's crazy, right? On average. Let me be clear, on average, right? Obviously, there could have been some downturns in there somewhere, as you can see from the peaks and valleys here. But yeah, I mean, it's had a huge growth. So for it to have a little bit of a downturn, not a huge deal. It's going to rebound eventually. It'll be fine. Unless something drastic happens to the fundamentals, to the business model, to regulation, something like that, that's actually going to impact this. And tariffs are not going to impact it long term. There will be some short term issues, sure, but I just don't see tariffs impacting any of these stocks long term. Apple. Let's look at Apple. Okay, obviously impacted a lot by tariffs because all their phones are produced pretty much overseas, between China, Vietnam, and some other places, I think. And so phones and components are all overseas, and so they're going to be impacted a lot. But down 7% today, 13% over the last 5 days, 20% in the last month, 25% year to date, and in the last year, still up 12%. Are you starting to see a little bit of a trend here? A lot of cases, these stocks are down substantially year to date, but they are still up within the last year. So they've had a huge growth in the last few years. Huge growth in the last few years. Over 5 years, up 212%. So Apple didn't have quite as much growth over the last 5 years as NVIDIA and Tesla did, but it's still got some pretty sizable growth each year. I mean, that's still, let's see, what is that? About 42% per year. I'll cheat and use my calculator there. So about 42% a year, right? And over the last 5 years, that's still pretty good growth, okay? Let's take a look at some of the ETFs. All right, so this is the S&P 500 ETF with Vanguard. All right, so last days down 6%, last 5 days down 8%, last month down 14%, year to date down 18%, and over last year it's still up roughly 1%, 0.75% roughly. All right, so it's still up in the last year. Look at the last 5 years, up 110% in the last 5 years. That's still averaging over 20% a year returns on this S&P 500 Growth Index Fund ETF. Okay, so if you're seeing a trend here, like, why are we so concerned right now? I don't know. I think people are freaking out. Maybe it's the media that's kind of got people freaked out over all this stuff. But I think we're still in pretty good shape. Okay, 6%. So Vanguard Growth Index. All right, 6% down one day. Last 5 days down 8%. Last month down 15%. Year to date down 19%. Last year, all right, last year it's only down 1%. Now that's interesting compared to some of the other ones. So that one's actually down 1% in the last year, which is interesting because a lot of the Mag 7, which are the stocks that we've been looking at, those are the 7 individual stocks that we have here. They're all a part of this growth index. I'm pretty sure. I'd have to double check on that, but let's see if we can. Do we have the holdings in here somewhere? I don't know. I'm not going to waste the time on the live show here, but I'm pretty sure a lot of those Mag 7s are a part of this ETF, and so that's kind of interesting that one's down a percent, but still, it's only down 1% over the last year. Let's look at the last 5 years. Last 5 years, still up over 20% a year. Okay, so again, still doing perfectly fine. We're doing good. We're achieving some good returns, some good goals over the last 5 years. All right, Vanguard Total Stock Market Index down 6% for today. Last 5 days down 8%. Last month down 12%, about 13% rounded. Year to date 14%. Last year it's down 2%. Okay, and the last 5 years it's still up 101%. All right, so we're noticing that these ETFs, for whatever reason, over the last year are down 2%, even though a lot of the individual stocks that we've been looking at are actually up over the last year. But over 5 years, they're still getting some decent returns. So this total stock market index still 20% annual returns. Okay, so still doing pretty good here. Let's see next. Vanguard S&P 500 ETF down 1% or 6% today, 8% over the last 5 days. Last month is down 12%. Year to date, we're down 14%, and last year we're down 1%. Okay, and over the last 5 years, again, still over 20%. So look at all these Vanguard ETFs, right? There's 4 Vanguard ETFs that we looked at just now. They're all up over 20% over the last 5 years, even with the current downturn that we're experiencing year to date. Okay, so is this a situation where you should be super concerned? I don't think so. Meta platforms, all right, 27% down for today. Or sorry, looked at the wrong number. 5% down for today. Last 5 days, we're down 10%. Last month, we're down 21%. Year to date, we're down 14%. Last year, we're down 1%. Okay, so this one is down probably no, it's about similar to those ETFs. So down about 1% over the last year. And in the last 5 years, though, look at the chart. Okay, so up 227% over the last 5 years. That's over 40% per year. All right, so it's still doing super good. All right, so Amazon down 4% today, 9% over the last 5 days, 16% over the last month, 22% over the last year to date, sorry, and then 5% for the year. Okay, so this is the most down for the whole year, for the last year, excuse me, not the whole year, but the last year. This one's the most down, at 5%. And over the last 5 years, this also did not achieve at least a 20% return each year. So a lot of the ETFs that we've looked at all achieved 20% returns or greater over the last 5 years. Amazon, however, has achieved less than that. Let's see, what is that? So that's roughly about 16% returns over the last 5 years. Still a good return. I mean, still a good return at the end of the day, but it's definitely down quite a bit compared to these other stocks we've been looking at. Okay, Microsoft. So Microsoft, we're down 4% for today. We're down 3% for the last 5 days. We're down 7% for the last month. And year to date, we're down 15%. Last year, whoa, look at Microsoft, down 14%. Now, I don't know exactly what's causing Microsoft to be so far down, but that's the one that's probably dragging down the Mag 7 in terms of some of those averages on some of these growth funds. We're starting to see that this is probably going to be one of the drags on the market there, because Microsoft is up there with some of the highest valued companies. Obviously, that's why they're in the Mag 7. And so having that down 14% in last year could definitely be a reason why. But look at the last 5 years, still over 20% returns in the last 5 years. So, if you've invested in the Mag 7 in the last 5 years, you're still doing pretty darn good. And the last one we're looking at here is Google. All right, so we're down 3% for the last day, 5% for the last 5 days, 15% for the last month, 23% for year to date. We're down 3% over the last year, but over the last 5 years, we're still up over 20% per year, closer to like 25% per year. Okay, so all in all, the Mag 7 is still doing pretty good over the last 5 years. All the stocks except for Microsoft have been up over 20% or more for the last 5 years. So if you own the Mag 7, you're still doing phenomenally well. Is it time to freak out? I don't think so. I think a lot of them still have great opportunities for growth. A lot of great, positive things happening with them. And so I would say stay the course. And if you have any extra cash to put into these, go ahead and put some more cash into them. I mean, in terms of timing, that's your call. That's everyone's call. When's the right time? I don't know. Nobody knows. Nobody knows when the bottom will be. Will it be today? Will it be Monday? Will it be next Friday? No one really knows. And so that's where dollar cost averaging comes into play. You just let's say you got $20,000 to put to work. Okay, maybe you break that down into 4 entrances. Okay, so maybe he puts them in on Monday, if assuming the market is down again, puts them in on Monday, and if it goes down another 5%, puts some more in a few days later. If it goes down another 5%, puts some more in a few days later. And eventually you'll kind of get to the point where we probably will hit a bottom. It'll start to go up a little bit again, and you could throw a little bit more in while it's still down just a little bit from where the highs, but you're still kind of have great earnings or bandwidth in terms of getting some good growth on that investment opportunity. Okay. And the last thing we'll look at, which isn't technically a stock, but it's something that a lot of people are investing in. And obviously you've heard me talk about this a lot, and I believe in it quite a bit. And that's Bitcoin. Okay. So Bitcoin is the only one that we've looked at so far that's actually up today, not by much, but it is up a little slightly. Okay. Last 5 days, it's up 2%. Last month, it's up less than 0.5%. Year to date, it's down 10%. Okay. So doing pretty bad on year to date still, but not as bad as some of those other stocks and ETFs we've looked at. Okay. Last year, it's still up 22%, even though it's down year to date. We're still up 22%. And the last 5 years, look at that. So very similar to what you're seeing with NVIDIA. Let's go back to NVIDIA. So NVIDIA actually outperformed over the last 5 years Bitcoin, okay, even with the downturn in NVIDIA recently. But Bitcoin is higher than a lot of these other Mag 7s as well as a lot of the ETFs. And so something to kind of think about and consider as a potential investment, or at least a portion of your portfolio going forward. Something good to kind of think about and consider there. And so those are the stocks in Bitcoin that we'll kind of look at, investments that we'll look at for today. I'm going to go through and do some more of these with some other investments and stuff like that in the coming weeks, especially with Financial Literacy Month being this month. Something that I wanted to do is talk a little bit more about some stocks and stuff like that instead of just always talking about tax tips. I think this is something that's important. I hope that everyone can kind of take some time to look at their portfolios, understand what's actually going on, look at the stocks and look at the trends and the histories of these stocks. As you saw today, I mean, if you look at the 5-year growth on your stocks in your portfolio, or ETFs or mutual funds, whatever you might have, you're going to see that I think for the most part, you'll be in pretty good shape still over the last 5 years if you've stayed invested. People who usually will end up missing out or losing money in these types of situations are people who are selling into these dips. People who are buying into the dip typically end up faring better in the end. And so that's the encouragement today is stay the course, stand firm. Don't freak out too much. Don't let the media freak you out too much. Even if you hate Trump, I get it. It's all good. But you don't like the policy that's going on, that's fine. But think of it this way. Always think about opportunity cost. The opportunity right now is that the market is down. So take advantage of it. Even if you don't like how we got here or who created it, the issue, or whatever the case might be, take advantage of the opportunity, right? Buy a little bit and enjoy yourself. You'll be thanking yourself probably later in the next year, next 5 years down the road for buying in at this time, putting some money to work. It's a great time to get in there. So, well, thanks everybody for tuning in. Hopefully this was helpful for some people to kind of get a little level set on some of the tariff talk and the market talk and kind of what's going on, maybe help quell some of the fears a little bit. And if you have any questions or anything, feel free to leave a comment. If you're a client of mine, feel free to reach out to me directly. We're happy to help out with whatever you got a question about in regards to the markets or taxes and all that good stuff. Okay. So thanks everyone for tuning in. With that, we'll go ahead and end this broadcast. Have a good one. Have a good weekend. Bye.